Okay, today, ladies and gentlemen, we're going to be looking at financial ratios. So, this is a really important topic for your exam. In fact, it's one of those things that you cannot make up. And so, I'm doing this not only for you guys, but also for myself, so that I feel like I know them properly. And I'm going to be going over not only the equations, but also the type of ratio and the purpose, which is important for like 9 or 16 markers if you need to analyze the purpose of a ratio, of why you've used a specific ratio. So, let's get started. Firstly, we're going to look at ROCE, return on capital employed. Now, that's kind of a fan favorite. What is return on capital employed? Well, it is kind of as it sounds in the name. It's to assess whether the business is making a satisfactory level of profit from the capital it has available to it. Now, what does that mean? It's basically just saying, are we converting the monetary capital that we have, how well we're converting that into our profit? And so because it's about profit, it's a profitability ratio, one of the 4 types of ratios we're going to look at, which is all of them, and that is operating profit over our capital employed, which is total equity plus non-current liabilities to equal our capital employed. Now, non-current liabilities is long-term debt, and remember, the only form of non-current liability is a bank loan, but if you're working this out, you'll likely be given a balance sheet where it will be listed as such, non-current liabilities. Total equity will also be listed on the balance sheet as such. You should have a total equity section. But if not, then the section labeled equity, just sum all of those numbers. That will be things like share capital, retained earnings, and like cash reserves. To give you your, add that to the non-current liabilities times 100, very important, to give you your return on capital employed. And because we're timesing it by 100, it's a bit of a hint. It is a percentage unit. On to the next one. The next one we're going to do is the current ratio. The current ratio is to identify whether the business is likely to run out of its liquid assets in the short term. And I've drawn a little arrow here to say cash flow, because essentially all the current ratio is telling us is whether or not we're going to have a cash flow issue in the short term. Now, why would we have a cash flow issue in the short term? Well, it's because we don't have enough short-term assets or current assets to pay off our short-term debts or current liabilities. And because we're talking about liquid assets, it is a liquidity ratio. And as mentioned, we're talking about current assets divided by our current liabilities, i.e. how many assets we have to cover our liabilities, how many current assets we have to cover our current liabilities. And because we're talking about the number of assets, the number of liabilities, it is a ratio expressed as the pounds of assets we have to 1 pound of liabilities. And it's the only one we express as a ratio. So just write the number you get from this equation, colon 1. So you're expressing it as to 1 pound of liabilities. And that's it. Easy as that. Okay, the next one we're going to look at is gearing. So what is the purpose of gearing? Well, it's to measure how reliant the business is on debt as a source of finance. Now, that allows us to ascertain 2 things. Firstly, the impact of a change in the interest rate. If interest rates increase and we're highly geared, that means our debt repayments are going to increase, increasing our costs. It also allows us to tell if there's any long-term risk due to debt. So if we're a highly geared business and we're thinking in long-term cash flow, if we're going to be able to repay that debt, or if we're just going to keep having to pay that debt eternally because of the interest on that debt, and if there's any risk due to market changes, how that could affect the business. Now, gearing ratio is kind of funny. Actually has its own type of ratio. It is the gearing ratio type of ratio. And the equation for it is as such: non-current liabilities, which is our long-term debt, over our capital employed, which we saw earlier, is total equity plus non-current liabilities. Now, remember, non-current liabilities is just long-term debt. So that is just bank loans. It can only be bank loans, but it will be listed as non-current liabilities on the balance sheet. And then we times that all by 100 to make it a percentage, which is what the unit is. And the normal level of gearing, however, it depends on the industry. That's a good level of evaluation to say that it depends on the industry what a normal level of gearing is essentially between 25 and 50%. So anything less than 25%, the business is considered to be low gearing, and anything above 50% is considered to be highly geared. And that is gearing for you. Okay, the next one we're going to look at is payable days. Now, payable days is essentially telling us how many days it's going to take for us as a business to pay off the money that we owe to our suppliers, i.e. our payables. And with this information, we can decide whether a business is likely to have to default on one of its debts or one of its payables, one of the things that it owes to its suppliers. And if we have to default on a debt to our suppliers, that's likely going to end that supplier relationship. But it will also damage our supplier relationships with all of our suppliers and potentially reduce our supplier deals and definitely reduce our bargaining power with new suppliers, because suppliers are now going to see us as a higher risk client because we had to default on a debt. Now, because we're looking at payable days as how quickly we can get rid of our payables, because remember, we want to pay off our payables as quick as possible, so we have to pay as little interest as possible. It is seen as a efficiency ratio. And the equation for it is very simple. It is just payables divided by our cost of sales times 365. And because it's in days, the unit is obviously days. Okay, the next one we're going to look at rather obviously is receivable days. Now, the purpose of receivable days is to measure how long it will take for the business to receive all of the money that is owed by its customers. And that tells us the likelihood we're going to have of bad debts. So bad debts is when we have somebody who owes us money who doesn't pay it back. And what we can do to supplement bad debts is basically debt factoring, which is when we sell off our debts at a lower rate to an organization that thinks that it can reclaim all of the money of that debt, but it allows us to get a bit of that money back that is tied up in the debt. And so it is an efficiency ratio, and its equation is receivables divided by revenue times 365. And again, it is in days because obviously it's called receivable days. Okay, now the next one we're going to look at is inventory turnover. Now, the purpose of inventory turnover is to tell us how many times the business was able to sell off its complete inventories. And with that, we can work out the speed of sales. So it's an efficiency ratio, and the equation for it is the cost of sales divided by the average inventories held by the business. And because we're talking about it in the number of times it was able to sell off its inventories, the unit for the ratio is times. Okay, and finally, we're going to be looking at profit margins. So I've decided to combine all of them together because they have the same equation essentially. So that's going to be gross, operating, and profit for the year margins. So just as a quick reminder, gross profit is our revenue minus our direct costs. So that's things like our raw materials and direct labor costs. Operating profit is that minus other costs such as hiring managers, any indirect costs. And our profit for the year is all of those minus additionally interest and taxes. And because we're talking about profits here, it's obviously going to be all profitability ratios. But the purpose of them does vary slightly. So our gross profit margin is to tell us how well the business is doing at adding value to its raw materials. Our operating profit margin is telling us how efficient the business is at generating profit from its operations. Our profit for the year margin is telling us how well shareholders/owners will benefit financially from their investment within the business. And the equation for it is very simple. So that is literally just the type of profit, so how much profit we have, divided by our total revenue times 100. i.e. how much of our revenue is converted into that type of profit. And the unit for this, because it's times 100, is obviously percentage. And there you have it, all the financial ratios.